Hi everyone, Joe Gentili from Left Tail Risk Advisors. In this video, I want to go through a benefit for cash value life insurance that I had not really previously considered all that much, but now that I've seen it explained, it actually makes a lot of sense to me, and I wanted to share this. And so I was watching a presentation by a retirement planning expert whose name is Ed Slott. Ed Slott's written a bunch of best-selling books. He's done information series on PBS. He's a pretty well-known figure, and I've heard of him before. And he has a framing on retirement that he thinks that there's a concern or a likelihood that income tax rates in the future are going to be much higher than they are today. And the current way that people are saving for retirement leaves them vulnerable for this. And so he thinks that the US government is carrying a lot of debt. And at some point, they're going to have to pay down that debt. And one of the ways they're going to do that is by raising income taxes. And so if your retirement planning is very reliant on 401k plans and SEP IRAs and IRAs, there's a vulnerability because you're putting in money pre-tax today and you're going to pay taxes on it when you take that money out. You're going to pay ordinary income taxes when you take the money out. And if ordinary income taxes are much higher in the future, then the amount of money that you have to actually use in retirement could be less than you think. And his advice to folks is he's not necessarily saying that it's bad to use these tools, to use a 401k plan or SEP IRA or an IRA, but he's saying that you should consider moving some money into savings vehicles for which the future income tax rates don't really matter for it. And so the examples that he gives for that are Roth IRAs, where you put post-tax money in, and then when you take the money out, it's not subject to further income taxes. So if income tax rates go way up, it doesn't impact the amount of money you can get out of your Roth. And the other thing he points to is cash value life insurance. He views cash value life insurance as the most tax favored asset in the tax code. I honestly can't say if that's an overstatement or not. It very well may be, but it is very true. And what he points out to is that when you do put money into a permanent life insurance policy that has cash value, generally you're using post-tax money. You're putting the money in, and the cash value grows, and you're able to access that cash value through policy loans and not pay income taxes when you're doing that in the vast majority of situations if the policy is properly maintained. So he thinks that folks should hedge against future tax increases, against the possibility that that happens, by taking some of their money and putting it into cash value life insurance and Roth IRAs, where you're able to basically have some certainty that the income that you're drawing from that would not be negatively impacted by future tax increases. So it's another way to look at cash value life insurance. Obviously, people use it today for a number of risk mitigating reasons to insure against losing somebody as their life as an income source, to hedge against a premature death or even a mature death, to hedge against estate taxes. There's a lot of ways that life insurance can be used to reduce risk in somebody's life. And he's giving another one, which, to be honest, I didn't consider all that much, which is it could be used to hedge against future income tax increases. So I think that's a very smart consideration and just another reason to consider cash value life insurance as part of your financial life. I wouldn't necessarily recommend it if that is the only reason why you would want to have cash value life insurance, but I think it should be part of the mix when you're thinking about whether it makes sense for you or not. So if you have any questions, please feel free to reach out. And as always, if you enjoyed this video, if you found it helpful, I encourage you to like and subscribe for future ones. Thanks.